Alright, so crazy stuff. The White House just released a press statement recently telling us about what's about to happen to the economy and what they expect. So in today's video, I want to give you my 2 cents about what I think will actually happen, because this week on Thursday, July 28 at 8:30 a.m., we will know finally and officially whether we're in a recession or not, because the BEA, the Bureau of Economic Analysis, will release what's called the second quarter advance estimate. And if that report and the number comes out to be negative, doesn't matter what number, just as long as it's negative, then we will be in an official recession. But the truth of what it actually means is that we will have already been in a recession for the last 6 months. Because remember, the GDP data is always backwards looking. Now, personally, after years and years of investing, I've learned that the grown-up traditional investing advice is to stay the course and do nothing regardless of what happens. So no matter what we find out this week about the economy, my personal investing strategy will still stay the same. When it comes to stocks, for example, the strategy will always be to continue reinvesting into the same old blue chip dividend stocks that I've been buying since 2014 and reinvesting all of that monthly income via the DRIP, the dividend reinvestment method, back into the portfolio itself. That will not change. And the other part of the strategy is to continue buying and dollar cost averaging into the broad market index fund that is VTI. That is the ETF that I've been buying and I will continue to buy no matter what's going on in the economy. When it comes to the crypto investing strategy, I'm mostly focused once again on Bitcoin and Ethereum. Those are my major 2 holdings, and that represents no more than 10% of my net worth, or at least that's my goal. The rest of the stuff is just speculative and it's not really investing. I would never encourage it for anyone else because it's not investing, it's mostly gambling, and it's also made to explain a lot of the trends that happen on YouTube. And the other part of the investing strategy is just to put money into real estate, which I've done so far this year. So that is my investment strategy, and that will not change no matter what happens this week. Now, the reason I wanted to make this video though is because I believe we just got one of the biggest recession indicators yet, and that is a press release from the White House, which is trying to explain to us what a recession is and what it isn't. Now, I realize most people are probably not spending their time reading White House statements unless they're nerds and they're subscribed to my YouTube channel, so if you're not a nerd, stick around and let me explain exactly what they're trying to tell us. If you don't have the time to stick around, let me give you the explain it like I'm 5 version. Guys, this Thursday, the GDP might come out to be negative, but that doesn't mean it's a recession. It's a lot more complicated than that. Please, that's the explain it like I'm 5 version. Now let me give you the more thorough version of what they're trying to tell us, so let's get into it right now. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the relatively short video. So the first thing that I found was suspicious fishes from that White House press release was that opening line. While some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. And this is such a wonderful statement because it is a masterclass in politics 101 because it's a half-truth. Because on one hand, it is true that the GDP is just one variable to measure the business cycle. But that's not exactly what we're measuring. We're talking about what it means to be in a recession, which is absolutely 100% officially 2 negative GDP reports back to back. So that's the part that's not exactly true. It's kind of like if your significant other asked you, hey, where were you last night? And you're like, well, my location is definitely one way to measure my whereabouts. It's not the only way. For example, last night I ate pizza and it was delicious. You didn't ask me about that. So you see, it's really hard to answer that question. Too many variables. So it kind of addresses the question, but then not really. Takes it into a different direction. So I thought that was kind of funny. But then it goes on to say, instead, both official determinations of recessions and economists' assessment of economic activity are based on a holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. So basically it's saying, look, the GDP is just one way to measure the economy and the recession, but it's not the only way. It's all these other variables too. But the funny part is that the GDP is an amalgamation of all those variables, like the employment data, like personal incomes and production levels and all those things that make up the GDP. So it's like saying, if A equals B, B does not necessarily equal A. That's just simplifying it too much. The math doesn't work out. And then it goes on to say that based on my wonderful logic, A may not even equal B at all. Based on these data, it is unlikely that the decline in GDP in the first quarter of the year, even if followed by another GDP decline in the second quarter, indicates a recession. Of course it does. It totally indicates a recession. But this paper is saying even though we got a negative GDP in the first quarter of this year, that doesn't mean that we were in half a recession or a recession at all. And then it goes on to say it's the National Bureau of Economic Research The NBER's Business Cycle Dating Committee is who the official scorekeeper is for what a recession actually is. So let's take a look at that. The Business Cycle Dating Committee is not like a group of business people to date each other, in case you were wondering. Instead, it's just a tracker of the US business cycle. So to put it simply, it's a proxy or a measure of the levels of unemployment. So the spikes that you see here in this graph represent times when there was high unemployment rates. The paper is trying to say that instead we should focus on unemployment levels, which are totally fine, see, because there's no spikes to unemployment. But what they're not saying is that unemployment rates are not a leading indicator of a recession, because a recession happens first and then unemployment happens. I used to believe the reverse was true. I used to believe that either people were fired or let go or made to be part-time, and then after a while of this hurt, suddenly we declare we're in a recession. That makes total sense. But the reverse is actually true, and that's what the data shows. Check this out. See those gray bars right there? That's where the recessions are. And if you follow the trend of this unemployment line, you can see that the gray areas happen first and then unemployment spikes. And this makes sense because think about it. If the BEA tells us on Thursday that sure enough we are in a recession, we got a negative GDP in the second quarter, then that's when it could inform the psychology of the future business cycle. Because if I'm the owner of a business, I'm not gonna start laying off my employees because I have a sneaking suspicion of a recession. I'm gonna wait until I know for sure from the sources, because then when I know for sure, that's when I'll get scared. That's when I'll want to play defensively and start cutting my costs. I cut my costs by laying people off or forcing them to work part-time. And yet this press release is trying to tell us, look at the unemployment levels. There's no spikes. And this is true. We are historically at relatively low levels of unemployment, but that has also been true in the majority of the other times before recessions were declared. Not to mention, the committee does not consider inflation data. And that seems rather important in trying to calculate what the odds of a recession might be. Not to mention that they're also saying, guys, the recession is a lot of things. It's not just one thing. Look here, not there. Which is a little strange because if you look further down the press statement, it also says, oh, by the way, the committee does not even consider unemployment in its calculation. It's almost like I pulled out a deck of cards in the middle of this video and told you this video is not about the economy. It's about card tricks. In fact, true story, this is the first thing I've learned. It's called the Cobra cut, and it's the world's hardest one-handed cut. Looks like a cobra because the prey in the mouth and it strikes at its prey right there. Just wanted to show you how versatile I can be. But anyway, it's like a magic trick because they show you this graph instead, which shows non-farm payrolls, real personal consumption expenditures, real income less transfers, and industrial production all going up, which all implies that we are not slowing down and that potentially we're not going to be in a recession because according to these broader, wider metrics, it looks like we are still growing. And look, maybe that is true. We aren't going to get a recession. But either way, let's not change our mind and stick to the variables for what it means to be in a recession and not move the goalposts right before it looks like we're about to get dunked on. Either way, this next part of the press release is really interesting because the White House throws a curveball and mentions something called the Sahm rule. And here's exactly what that means. The Sahm rule says it identifies signals related to the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5 percentage point or more relative to its low during the previous 12 months. Don't worry, I had to read that line like 15 times to understand it. So here's what it's saying. If 3 months before these gray areas, which are recessions, these unemployment numbers are at any point 0.5% higher than the lowest point in the last 12 months before the gray areas, there's a good chance we're going to be in a recession because historically it has been a pretty good indicator of measuring that. Now right now, our Sahm number is at 0, which means in the last 3 months of unemployment data, we have not spiked 0.5% higher than the lowest point of the last 12 months of unemployment data, which tells us there's a decent chance that we're not in a recession now and that we shouldn't be in one anytime soon. And the reason is because our unemployment is relatively low. And believe it or not, this Sahm rule is actually more accurate in telling us about what's going on now because unemployment data comes out every single month, but the GDP data is 3 months behind. So ultimately, what the government is trying to tell us is that if we're looking in the first 6 months of this year, there's a decent chance that we could have been in a recession if the GDP numbers come out negative this week. On the other hand, if we're looking at what's going on today, there's a decent chance we may not be in a recession. And this is the distinction they're trying to make. And it's an important one, because if this Thursday we get a negative GDP report, then the first thing that's going to happen is the media will have a field day, and this recession is here will be the only thing we hear for the next few months. And that's important because how we perceive this news as consumers and as business owners definitely informs the future business cycle of how we spend and how we protect ourselves. So the government really needs us to believe that, hey, this is all fine and we might not be in a recession, because if we do get scared and we do get defensive, then we could go from getting a paper recession to a real bad recession where people actually do start losing their jobs and that unemployment rate spikes higher. At which point, if we combine that with the high inflation we have now, we'd actually get something called stagflation, which would obviously not be good. Still though, if I were a betting man, which I'm not, I'd bet there's a really solid chance that Thursday this week, the GDP numbers will be negative, which means we will have been in a recession at least in the first 6 months of this year. Otherwise, why would they put out a press release trying to educate us on these differences if the GDP numbers were good? It's like when you were a kid, Mom, would you be upset at me if I lost the keys to the house? Good, because I totally didn't. Said no one ever. So I know I lightly roasted this press release, but I wanted to be as objective about this as possible so you can hear out the government, but also see that your perception matters a lot to what the economy will do in the future. So hopefully you can separate some of the fact from fiction and make up your own mind. But at the end of the day, if it all is too confusing, just smash the like button and subscribe, and then press the J button on your keyboard to go back 10 seconds, which is probably the only real useful thing you've learned this video. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin. Remember, once again, please do not keep your crypto online. Grab the free money while it's there and then take it offline onto a cold storage wallet. And as usual, don't forget to grab your free stocks. Links are down below, and then go track them automatically with a spreadsheet linked down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes Wednesday. I'll see you soon. Bye-bye.